Startup investor tips. Should you pour money in early stage or late stage companies? As a startup investor, you have myriad choices when it comes to resource allocation, niche selection, and portfolio diversification. But which stage of the startup's life cycle should you focus on? Welcome back, folks, to another edition of Sweetie Kiwi. I'm very happy to have you today. I hope you are doing fantastic. I'm doing marvelous. If you are doing as marvelous as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about whether you should put your money in early stage or late stage companies. But before I get into the nitty gritty here, let me give a shout out to Tom Green from Manchester, United Kingdom, Elliot Watts from Manchester, United Kingdom, and Eloise Clark, also from Manchester. So Tom, Elliot, and Eloise, we really appreciate your support, your encouragement. Thank you so much for all the letters and all the nice signs and gestures of encouragement. We really appreciate it. Now, first, let's talk about seed and early stage investment, right? So basically, if a seed or early stage business generally seeks capital to invest in several things: product development, customer acquisition, building a team of employees, right? So they're basically looking for money to start their operations. All right. They focus a lot on product development. So a lot of the money goes into research and development. So they have the prototype. They just constantly do trials and errors. They constantly refine until the product is viable. The product is good. The product has passed any quality, all the quality reviews, all the quality checks. So basically, one thing you have to understand is that the money usually goes to beta testing. But some companies also are very good. What they do is while they have a beta product, they're also trying to, so they have beta products at different levels. So they have beta products at the initial level, and they also have a beta product that is close to getting marketed. So what they're doing is they have a hybrid strategy. So they have a go-to market strategy, and then they have a strong R&D strategy. Now, some of the money also goes out to build sales channels. Now, this is very important. The reason why I'm explaining the early stage and seed investment is that those companies, they are usually cash constrained. So they need money. So if you invest $1 million, don't be surprised if that they come back to you 3 months from now, 6 months from now, asking you again for another $1 million, because the money is just being burned to start the company. The money has been burned to do testing, refinement, testing again and again and again. Usually in the United States, a lot of those seed and early stage companies, they get money through family, through friends, and sometimes through angel investors. All right. Now, the thing here is that investments within the early stage or the seed stage generally takes two forms: preferred equity and convertible notes. All right. So the thing here is that you have preferred shareholders or convertible notes. Now, a convertible note is basically so you're basically putting money into the company, you're lending the money, but they give you a convertible note, meaning that you can convert at a later date that note, the amount that you pay them, into shares, into parts of ownership into the company. All right. This is very important to understand. Now, having explained fully what seed and early stage investments are and what they are, what the money is used for, now let's talk about the risks of investing in seed and early stage companies. You have several risks. Okay. Now, investing in anything, whether it is early stage or established business, comprises risk, right? It's just part of the game. You got to expect it. But when it comes to early stage and seed companies, things get a little trickier. Things get a little more, I would say things get a little risky here. First, you have the unknowns, right? So basically, let's say, the The company comes to you, they make a great pitch, you're comfortable with everything, you understand that they might make it, but there is a big unknown, there's a big question mark there. As the United States Small Business Administration has said in the past, 90% of businesses or startups fail within the first 3 years. So there is a big question mark that things might not pan out, right? So the thing here is that you just have to understand that even if you put in money, even if you've done due diligence, even if you've analyzed the product and service, you've analyzed the market, there is a chance that nothing will work the way the company anticipated. So that's the first risk. The risk of the unknown. The second risk is the risk of technology. The risk of technology. So basically, you have the company has an idea, but the technology either is not there yet, or they don't have enough cash to develop the technology to sustain their growth. All right. Think about companies that they were that basically were in operation a few years ago, or 10 years ago, 20 years ago, where there was no AI, there's no artificial intelligence or Internet of Things. Those companies might be visionary at that moment, but because the technology, the underlying technology was not available there, or they didn't have the money to develop that technology, they had to file for bankruptcy. It's the same thing here. So you want to make sure that the business model of the company relies on something sustainable, either existing already or something they can create themselves. Another risk that's very important when it comes to early stage and seed is what I call founders fatigue, right? Let's say, you have very charismatic founders. They are 2 or 3. They've been working 20 hours a day for the last 6 months or 9 months. And at some point they just get burned out. They get some kind of stress because the tension, the pressure is just too much. And you realize that, those guys or those ladies, they can't sustain it anymore. And you are actually betting, because if you're investing in an early stage or seed company, you are essentially betting on the founders or the products or services. But the founders play an important role because the company is too young to actually fly by itself. It's too young to rely on itself. It's too young to be independent. So, if you have a charismatic leader or a charismatic founding team, and they are exhausted, it's very important to make sure that you have at least a backup plan. You say you are able to identify a CEO to pick up and run the company. Another risk is the risk of running out of cash. Now, as I said earlier, it comes with the territory. If you have an early stage or seed company, they burn a lot of cash. So, there is a risk also, as I said earlier, that they might actually, run out of cash after 3 months or 6 months, coming again to you and ask for more money, or go to. So the thing here is that there's a way to mitigate that. When you give them the cash, make sure you have a clear plan as to the uses of the funds, right? Another risk is founder disagreements. This is actually a bigger risk. Because if a business arises because 2 or 3 or 4 or 5 people were able to get around a table and say we agree to do this, but once they start, if there is a disagreement, this might impact the whole company. So, and believe me, it's very common to have disagreements, whether it is among co-founders or between founders and investors, right? So conflicts are inevitable. You cannot foresee them. You cannot avoid them. We're all humans. Nobody's perfect, right? So what you want to do here is that you want to be able to find a way to solve these issues without resorting to legal tools, right? But the risk is there that, if that happens, your investment might suffer. All right? I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are still continuing our conversation here about startup investing and whether or not you should invest in early stage or late stage companies. Now, before I talk about the number 2 here, the late stage investments, I want to quickly give a shout out to Adam Kelly in North Salt Lake, Utah, Alex Kelly, Salt Lake City, Utah, and Lola Gordon in Provo, Utah. Thank you so much for supporting us. If you just joined us, please consider subscribing to our channel. Turn on the notification bell so you are aware whenever we drop a new show. So like this show, share, and comment below. Okay. Let's talk now about late stage investments. This is an important thing. Now, late stage investments, basically, I mean, what is a late stage company? It is a business that has shown viability as a going concern. In other words, it has a well-known product or service with a strong market presence, right? So they have this operational history you can rely on. You can go back maybe 10 years, 15 years, right? And this kind of companies, usually they have reached a point of positive cash flow generation, right? So what they're doing is that they have enough money, they have generated enough cash, and they are beginning to experiment with expansion plans, right? Maybe they want to get into tangential markets vertically or horizontally, right? So, but whether they want to buy their suppliers or their rivals or their customers, either way, this is a company, a late stage company is comfortable. They are fine. Now, the reason why you might ask, why do they need money then if they're that comfortable? Again, it's because of expansions or because of operational history. They need cash to constantly evolve. Even all the big companies you have on the Dow Jones, they constantly borrow, right? Constantly. So, and those can be they can be called a late stage companies, a late stage company also. So the thing here is that it's just important to mention that investing in a late stage company can be as risky as investing in an early stage company, even though the late stage business has more operational history and in some cases more cash on hand. All right. Now, one thing you have to understand is that when you invest in a late stage company, the investment life cycle might be a little longer because those companies are already established. So they have the comfort of developing long-term plans, long-term goals, right? It could be 5 years, it could be 10 years. All right. So understanding the life cycle stage at which your investment will be made is important in properly capturing the risk and return characteristics associated with that investment. Speaking about risk and return, what are the risks of investing in late stage companies? Now, the thing here is that the investment in late stage companies usually are illiquid and highly speculative, especially if the company is not publicly listed, right? So you have a lot of private companies that are growing and they've hit the point where they feel like they need money, they need extra cash to be able to move on. So you want to make sure that you research that aspect of things. You also want to look at the sector in which the company is exercising, the company is operating. Very important. Are they in a dead, quote unquote, dead industry? Because some companies might be having a lethargic growth metric simply because they are in the wrong sector, right? Which is why maybe they wanted to get out of they needed the money in the first place because they wanted to get out of the sector and move on into another. But you want to make sure that before you pour your cash into it, make sure that you analyze the balance sheet and the income statement of that that late stage business to identify where they are in the operational life cycle. All right. Another thing you want to pay attention to is the legal aspects of things. So the legal aspects of things is very important. Are you coming on board as a shareholder, as a common shareholder? Are you coming on board as a preferred shareholder? Are you coming on board as a convertible bondholder? Right? I mean, the definition of those terms is beyond the scope of this show, but we have an entire show dedicated to that, to convertible bonds, to preferred stock and common stock. You might want to check it out and learn more. All right, I'll be right back right after this. Do not go anywhere. Welcome back, folks, to another edition of Sweetie Key. We're still here having a conversation around whether you should put your money in early stage or late stage companies. And I want to quickly acknowledge some of our viewers and listeners, particularly Tom Shaw in Porcupine in South Dakota, Nikki Lawson in Rapid City, South Dakota, and Ruby Powell in Pierre, South Dakota. Really appreciate it. So today's conversation, let's just recap it. So I spoke about seed and early stage investments, the risks of investing in seed and early stage companies, and then I spoke about late stage investments, as well as the risks of investing in late stage companies. Right. So before we wrap up, let's talk about the call to action. Today's call to action is very important. To invest means to manage risk, right? If you want to, whether you're investing in early stage or late stage businesses, at the end of the day, you got to become adept at managing risk. And you want to make sure that and the first way to control the risk when it comes to startup investments or, just early stage or late stage is you have to negotiate the valuation of the company, right? Because higher valuation by definition means more risk associated, right? So you need to invest more to increase the value, right? Now, you want to also pay attention to things like, the legalese. You want to pay attention to the term sheets, to the legal structure of the company. You want to pay attention to something like vesting, right? Which is the agreement that implies the founding team needs to stay, let's say 5 years or 10 years at the startup to receive a certain number of shares, right? The liquidation preference, anti-dilution, and lockup. Now, lockup is very important because lockup puts in place limits that prevents founders from selling or leaving the company from a certain period. And this is very important, right? Because the last thing you want is to put money in the company and then 6 months later realizing that all the founders are jumping ship. They're just getting out of there, right? Because if a founder is leaving is actually leaving the company and selling his or her shares, something is going on, right? So this is very important. Another thing you want to pay attention to is the selection and evaluation. I already talked about evaluation, but the selection is very important. So the team, the competitors, the business model, do they have market traction? So again, it doesn't matter whether it's an early stage or late stage. You want to determine whether the company has traction, market traction, right? You want to pay attention to the exit strategy. Pay attention to the projections. Projections are key, folks. Projections are very important, especially when it comes to the horizon. Is it 5 years? Is it 10 years? So that's very important. So there are 4 types of projected financial statements. So you have the balance sheets, the income statements, the statement of cash flows, and the statement of stockholders' equity. If you have an early stage company, chances are you have projections. Those financial reports will be based on assumptions, so they will be projected data. But if you have a late stage company, aka an established company, they should be able to produce actual and historical financial reports to you. And if we were to be even more thorough, you would want to ask them to make those audited. You want them to have outside auditors, review those statements to ascertain the integrity and the propriety of those statements. All right? Thanks so much for listening to us. I will see you next time. But until then, stay marvelous.